Right now we're seeing a lot of central banks acquire gold. That's not the same as crypto, because crypto's different that way, because still, who controls it? Is it controlled behind the scenes, or do you have possession of it? And so for those reasons, I prefer gold to crypto. Just to give you a little bit of background about the 5 forces, I've been a global macro investor for about 50 years. And some of the times that I've been surprised, I was surprised because things happened that didn't happen in my lifetime, but happened before. So I found that by studying history before, it helped me. For example, I studied the 1930s and the Great Depression, and that allowed me to anticipate the 2008 financial crisis and do well when others had some trouble. So I saw recently 3 big forces that led me to the 5 big forces that I saw repeat over and over again in a cyclical kind of way. Okay, what are those 5 big forces? The first force is the credit, debt, money, economy force. In other words, you give credit, you're giving buying power, but buying power, that credit produces debt. Debt means you have to pay it back. Then it becomes a cycle, and it becomes what the economic and market cycles are driven by. That's one force. Second force is the force of internal order and disorder, particularly internal conflict. Particularly when there are large wealth and values differences, that there become irreconcilable differences in which there's populism of the right and populism of the left. In other words, extremism of the right and left. And they are irreconcilable forces that produce a conflict internally that's basically a type of war of one side to win over the other. The third force is the great power conflict of one country competing with another country. Classically, the rise of a great power to challenging an existing great power. And when you challenge existing great power, you challenge that power's rules, and that means you challenge the order. And so we're seeing that now as China and other countries are particularly rising to become competitive. And then what is the dominant power? The United States is no longer the single dominant power. And then I discovered fourth, acts of nature, droughts, floods, and pandemics have killed more people than wars and toppled more orders. So number 4, certainly, and certainly now, climate change. The costs of climate change, the impacts are very large. And that through all history, the biggest force, most powerful force in creating the evolution is man's learning, particularly of technologies, the invention of new technologies and ways of operating. And certainly that's the case now with AI and other other technology developments that are going to change how we're operating. So I watch these 5 forces move in cycles, in great cycles. What's happening now is very similar to the 1930 to 45 period, and that's the nature of the dynamic. So anything that we're going to want to talk about or anything that's important will fall under at least one of those categories. And so I think when we're sitting here today and we're thinking about the future, we have to think about those things. Again, I'll start with the dynamics and then we'll deal with how to tackle them. One man's debts are another man's assets. And when debts rise quickly, that means you have to sell that debt so that somebody has to buy that debt. And when they want to buy that debt, they are buying it based on the return that they're going to get. And when there's a lot of debt relative to GDP, it's a difficult balancing act for central banks because they don't want to they have to be careful to keep interest rates high enough that they're good for the creditor without being them so high that they're bad for the debtor, and that balancing act becomes progressively difficult. And what they do when they reach an imbalance is they print money. And so we've seen the creating of large debt and the printing of a lot of money causing an inflationary pressure, and that's the way the machine works. Okay, so now neither of the parties are really thinking about that balance and how to deal with that. There's a different philosophy. The Trump administration is more going to follow a policy very similar to the policy that existed in the right-of-center governments in the 30s. They're going to become protectionist. They're going to raise tariffs a lot. And that tariff will be taxes, essentially. It'll give income. So there's an element of income that's going to come from that. And then that protectionism is to try to build up the American industry, not just for an economic reason, but because there's a sense of self-sufficiency is needed in case we get into a war. And you're going to see that in chips, you're going to see that in electricity, we need power. You're going to see a plan, an industrial plan, not capitalism as we ordinarily think of it. We think of capitalism as a free market. And so if you want to buy something luxurious and you want to, no, this is much more top-down and directed. And then there'll be more in military spending and the like. And so we're going to deal with this imbalance. And that part of that is also the changing of the world order. We're no longer, the United States is taking care of the world order as it designed it, but it is instead taking care of itself, America first, in a world order in which then there's that conflict. So that's the nature of that beast. That's for that reason. I think that there's a supply-demand imbalance issue that not only will come from the new supply, but also the lack of desire of holding bonds, because there's a lot of debt which is held. And when you start to think, is that a good currency? Is that a good storehold of wealth? Increasingly, there's the risk that will be sold. And that's one of the reasons that you're seeing gold and you're seeing Bitcoin go up, because we're talking about what is an alternative money. A money is both a medium of exchange, but a storehold of wealth. And so now you're seeing more movement in that direction because it's precarious. I don't think the Fed handled it in the right way. There were two big stimulations. And the amount of checks that went out to people from the federal government, again, remember, federal government can't print money. Mm-hmm. What they do is but they can distribute money. So what they do is they borrow money. So the Fed lent money to the central government that send out checks, and they sent out more than twice as much money as the negative impact from the COVID was. In other words, incomes were set back, but they sent out twice in two big waves. And of course, if you send out more money with buying power, then you create more prices going up, you create the inflation that we've experienced. And so I think people are paying attention not just to the word inflation, which is the rate of change, but looking at prices. And so if you look at the prices of everything, almost every place, depending where they are, they're up significantly, prices of most everything. And that's then was a political issue. So yes, I believe that they were, for two reasons, they were too stimulative. They were stimulative the first go around because of COVID, and maybe they would say, I didn't want to be stingy, I want to make sure we had more than enough. They were around, there was the second time around when the Democrats and Biden got elected, and they're talking about the redistribution of wealth, universal basic income. That was past the first go around, and there was another big wave of money. And that combination of that big wave and the printing of money produced the price changes we're seeing. Now, my view on cryptos remain pretty much the same, and I'll articulate it. First of all, I think that, and I own crypto, I own some Bitcoin. The question is the amount and how attractive it is relative to gold, okay? I think that there's kind of the old man's gold and then the younger man's crypto. But the important thing, first of all, is to represent whether one or the other, and really ideally some of both, should be in the portfolio. Don't be so fanatical that you're just having one and not the other. And do worry about the value of money and what is your alternative money that can't be printed. Okay, so now when I look at gold and it's evolved over, I mean crypto, and it's evolved over time, there have been a few things. First of all, there's not the privacy element of crypto. Everybody can understand exactly what it is. You can tax it easily. So governments can easily tax it. It doesn't have the same element of that privacy. There's a saying that gold is the only asset you can own that's not somebody else's liability, meaning you have to depend on somebody else. You can own it and so on. Gold has always been a reserve currency in all times. It's the third largest reserve currency. In other words, the largest is the dollar, second is the euro, third is gold, and fourth is the yen. So it's always the currency that's being gone to. Right now we're seeing a lot of central banks acquire gold. That's not the same as crypto, because crypto's different that way, because still, who controls it? Is it controlled behind the scenes, or do you have possession of it? And so for those reasons, I prefer gold to crypto. But I think the important thing is the recognition of the issue of do you trust the governments? And I think that to trust the governments, that they won't print the money to make the debt service easier is not the best move. So I'm, sort of anti-debt assets like bonds and so on, and I prefer the other. But I would say that should just be a portion of the portfolio. I don't want to get carried away with that. I would say that if you look at it as a diversifier, I think particularly gold is something that if you look at how it behaves in relation to inflation and also interest rates, it behaves in a way that's more understandable than Bitcoin. Bitcoin is more of a speculative element with this limited supply aspect to it. So, but if you look at that, it's an effective diversifier of the portfolio. If you take most other assets, stocks, bonds, real estate, and so on, they will generally have good times and they will do well. The gold and that is a diversifier. So you actually reduce your risk by having some in the portfolio, somewhere between 10 and 15% of the portfolio.